The video you're about to watch is my friend Scott Barrett, and you know who Scott Barrett is? He is the exact best cross between the coolest bartender you've ever met in your life and the geekiest numbers guy you've ever met in your life. So he's going to come across and he's got all sorts of jokes, but the best part is the strategies that Scott Barrett's going to go through are advanced strategies for having rental real estate. So if you really want to learn the real nitty-gritty of how to make those rentals the most effective, when to refi, when to do 1031s, you're going to learn it today. So without further ado, let's get right into the video.
Okay, I'm Scott Barrett, and I am a realtor, one of many here apparently. But I got my license to be able to find rental properties, and that's kind of how I got started with this. And then what ended up happening is I started learning how to do all the analysis and everything like that. All of the numbers came easy to me because I have a degree in accounting. This is just kind of what I do, and started working with other investors because I know how to break all this stuff down. But one of the big things that I found is working with people, they don't understand the numbers maybe as well as I did. So if I could simplify this for them, they tended to feel more comfortable moving forward and buying things, which was important because I sell things. Okay, so that's kind of part of that whole equation. So that was kind of how this presentation came to be, is for clients. So just real quick, we're going to talk about how do you compare one rental property to another. Okay. Real estate versus stocks. Compare Denver investing versus out-of-state investing. We'll have an example there. And then we have a big portion of it that is going to be, how do you do your evaluation on your existing properties? Okay. So we're going to start off by just looking at a property that is owned cash. Okay. So I don't want to have the loan part be complicating the numbers here. You buy it cash. Okay. So you have a couple of things going on after you buy it cash. You have money coming in, called rent, right? You're going to have a vacancy allowance or whatever, but that's going to be what you have coming in. And then you're going to have money going out, expenses. Expenses will be things like HOA, insurance, taxes, all of that. Okay? So you have what you have coming in minus what you have going out. You have net. This is your net cash flow here. Okay? So question. Is $10,000 a year a good net to make off a rental property? It depends. It depends. If you have a rental property that's $1 million, is that good? No, that's terrible. That's 1%. Okay, so if you have 100,000, if it's 100,000, is that good? 10%? And there are some people who will say, hey, I buy in markets where it's even better than that. So even 10's not good. But the thing that we can agree on is that these are two very different investments. And a lot of times I'll talk to people and they're like, yeah, I have this house and I've had it for years and it cash flows this much. Okay, well that's only half the equation. You're making that much compared to what? Like, what is it worth? Is it $1 million? Is it 100,000? Because that's a completely different investment. So you have to have both pieces of information to be able to determine this. So what is that number called? Cap rate. Capitalization rate or cap rate. Okay? So this is our equation for cap rate, money coming in minus what you have going out divided by the value of the property. Okay? We just said that this equals the net, so this is our equation for cap rate with icons, okay, to make it easy. So, and I know you can use internal rate of return, things like that. There's like a religious debate about what you should use here, but for giving a presentation here, just making it simple to break this stuff down, we're just going to use cap rate here. So that's how we'll compare one to another. So real estate versus stocks. And I put this in here because there are some people that don't know. Maybe this room is going to have a higher percentage of people that know this, that you can use your 401k and your IRA to buy real estate with it. Those of you that are new may not know this, so show you why you should consider real estate over stocks. So we'll start with stocks. And over the last 50 years, this is what you made on stocks. That much appreciation, that much you made on how much the stock itself went up. By the way, this is not including any taxes. I just took taxes out of the equation here on everything, the real estate and the stocks. 3.3% on dividends. And it's actually 10.18% is the average compounded over 50 years. So if you were to invest $25,000 with these kinds of returns for 20 years, $25,000 for 20 years, it looks like that. So, pretty decent return on your money. So you put $25,000, it goes to $174,000. Financial planners will tell you don't take more than 3.5% of what you have in your portfolio out per year. This is what you have for cash flow per year you go into retirement. So now let's look at real estate. So real estate, this is how you make your money, your returns. And remember all the tax benefits we don't have up here because we're taking taxes out. But it's how much the thing goes up, how much cash flow you get, and then, as you're paying your loan down, that's going to add your equity as well. So, both things are going to contribute to how much you make. So I'm going to show you the numbers we're going to plug in here. I use this, I had to make a big old spreadsheet and plug numbers in and map this out over 20 years to compare this to the stock. So just so you know, I didn't put like crazy numbers in there. This is the average appreciation in Denver over the last 40 years. 6.3% on detached single family, 5.9 on condos. It's been a little bit better for condos about over the last 5 years. This, you take any particular time span, it might be better for condos, might be better for houses, but it's about 6%. Some people will say, well, we can't continue this run up that we've had. This is like since 1970. But you can see that we have a trend here. We're kind of not very far off of a long-term trend. Also, one of the big things you'll look at to see if a market is overheated is debt to income. Because if people are making more, it's going to support a higher price. We're right about where they say you should be. And we have a lot of people moving here. This is the net migration. This is migration. This is natural increase to the population for Denver, and it's projected to go. So it's going to probably support that we're going to have pretty good growth. So I'm just going to say in this equation, we're going to use 6% as the average here. Okay, so then for the returns, what I'm going to do is I'm going to use a cap rate here. So if you have like a $100,000 property, we're going to say that, it's going to make a multiple of that. So, what is a good cap rate in Denver? I have this, and I know this is an eye chart here, but I have this on my website for clients that I'm working with buying rental properties. If you go to the website, you have to have a login to get to this. But this, the things across the top, the headings are this. The big thing we're going to look here is cap rate. And I have this sorted by cap rate, by looking at what is the average rent in a zip code, by number of bedrooms and all of that. And I crunch that against the database of the MLS, and then I sort it right here. So to blow this up, this is the top cap rates based on this that you're going to find in Denver, just so you kind of have an idea of what it is. Is it a 10 cap? Is it a 15? Like what's good, what's bad? You can find stuff in the 7s on just about any day on the MLS. You can find a few of them in the 7s. You're going to find some into the 8s, sometimes in the 9s. The ones in the 9s are going to be in complexes that are not completely gang-free. Okay? So I'm going to use a 6.8 just so you know that if I throw this up here with that kind of level setting, what's good, what's bad, you may not, if you're not familiar with this, you may not know that a 6.8 is a fairly reasonable cap rate to have here. So I'm trying to use reasonable numbers here. This is what we're using for the loan, 15-year 4%, which you can actually do a little bit better than that. But this is what the equation is going to look like. This is what a $25,000 investment, 25% down, and a $100,000 property. Just using that as a round number, because if you try to use the realistic numbers of, 138,000 or something like that, it gets really hard to follow this. Okay, so this is how real estate compares to stocks. So huge difference, huge difference. That's how it breaks down. That's your $25,000 investment. This is what this grows to. So if you look at this from a cash flow perspective at retirement, you're 45, you want to retire at 65, and you want cash flow, Instead of taking 3.5% out or a percentage out, it's just whatever your net operating income is. And remember, this is a 15-year loan, so this thing's paid off now. And it's over triple what you would make with the stocks. But, wait, there's more. Okay, so you can, with this property, in 5 years or so, in this case I'll say 5 years, take cash out and buy another property. I use 5 years because we're doing a 20-year example, 15-year loans. Both of them will be paid off at the end of 20 years. So the reason you can do this is you have this much equity in it after 5 years. If it's going up 6% a year, you've paid this much off on the loan. So you can actually do this. There's enough equity in there to do that. That's what it looks like with 2 rentals. A little riskier, but that is what is possible. And you can see this is what the cash flow looks like. Big difference. Big difference. So why is there such a big difference between stocks and that? Not taxes, leverage. So you can get a $100,000 asset for $25,000. Remember, the stocks were going up 7% a year, and the property's only going up 6% a year. So if you look at that, you would think the stocks are going to give a better return than the property, but the 7% on the stocks is 7% on $25,000. With the real estate, it's 6% of $100,000, which is way more money. If you don't buy with leverage, you are at about the same return as the stock market. If you have rentals and they're paid off, you're about the same returns as the long-term returns on the stock market. Plus, if you're in the stock market, you don't have to have tenants. You just have an exchange-traded fund and you're done. Okay, so yeah. So, personally, if I am going to have to deal with tenants, I want a little bit better return, and I'm willing to take on a little bit of risk and have some leverage. So the other thing is this is an active investment. The other reason besides the leverage is that this is an active investment because you do have tenants. Okay, out-of-state investing. This is one of my favorite parts of this, putting it together. So when I first got into this, looking at the rental properties and all that, I went to an REI club, not this one, and somebody got up. There's another one. Adam is about to put them all out of business, but there was one then. So somebody got up and said, hey, I have properties in Tulsa. We rehab these things. We put a tenant in there, and then you buy it for like $48,000. You rent it for $800 a month and whatever. And I'm like, these cap rates are amazing. I start doing the math on this. I'm like, this is like a 14 cap. And they're like turnkey 14 cap. I'm like, why would you ever invest in Denver? Ever. If that exists. So this, I have these big old spreadsheets of mapping this out every year for 20 years of the appreciation, and then you have when it goes up, now your cap rate is multiplied by a bigger amount and all this, and I mapped this out over 20 years to see what this would compare to. So we just saw this. This is the returns you get in Denver, the 6th that we use for appreciation, 6.8. So these two numbers are going to change if you go out of town. You figure you're going to get basically the same financing. But these first two numbers are going to change. So for this, I said the appreciation is going to be lower in Tulsa or Cleveland or Memphis or fill in the blank of these places that nobody really wants to live. They just can't afford to live in Denver, right? And I said, cap rate, I'll take it up high because people tend to say, well, I can get 15, I can get 16. 17 is a pretty generous cap rate here. And I think I might be even generous with this for some of these places, that they're going to be flatlined and be running the same 20 years from now because they just don't go up. This is what it looks like, total returns over 20 years. Side by side. It is a wash. Even at 2 and 17. 2 and 17. Like, I was a little surprised by this. Because so many people are into the out-of-town investing. And you just plug it in. 6% appreciation, 6.8 for Denver. 2 and 17. and just do it for 20 years. That's what it comes out to. Okay, so then the objection will be, well, okay, I'm 45, I'll retire when I'm 65, and when I'm 65, do I want appreciation or do I want income? You want income, right? You're retired, you want income coming in, and look at the income you make in Tulsa. This is what the income does over time. See how they kind of go together? It starts running together. It's 150% more in the beginning, because 17 cap on a $100,000 property is $17,000. 6.8 cap is $6,800. But up here it's only 20% more. So why is that? Well, what happens is these properties are worth this much and this much, comparatively, just kind of give you a visual of how much they're worth side by side. This one is a 6.8 of this amount. This one is a 17 of this amount. So you can see that's why the numbers start coming together and they go from 150 to 20. But then I was like, okay, use this analogy, you're 45, you retire when you're 65, what's going to give you the cash flow from when you're 65 to 85? If we map it way out for the next 20 years, it looks like this. It eventually just crosses, and this is where you end up making the most cash flow too. Now, if you need cash flow like right now, you can't beat, I mean, this is, Denver's not going to beat Tulsa. It's not. But if you want the best returns over time, over 20 years, like I said, it's a wash. That's being generous with the numbers for Tulsa. And the cash flow into retirement is going to be even better this way. So this is one of those things where I was kind of surprised, with my own numbers when I started mapping this out. So just something to think about. And the other thing is, like, if you live here and you have a problem, say you have a problem with your property management company, and you're like, okay, I got to go get a new property management company, I got to go visit my property or whatever. You want to drive across town, or do you want to go to Tulsa? Like, who wants to go to Tulsa ever? Nobody. Okay. Now, this is existing rental properties. And this is where you have to pay a little bit closer attention because we're going to get into a little bit of math. Okay? But this is really important for, people get a property, they'll do all this analysis to make sure they have the right cap rate and all that when they buy a property, and then they will do no analysis moving forward, and that property sat there for 10 years, and maybe they should be making some different decisions on how to allocate their money. Maybe they shouldn't be in that property anymore because the numbers made sense before, but they don't make sense now, and it's important to do an ongoing analysis of your numbers with your rental properties. So that's what I'm going to talk about here. So there are two different things that you have to analyze on a rental property. You have to look at how well the property produces, and you have to look at how well your money produces. These are two different things. They are two different measurements. And one can be good. They can both be good, both be bad, and one or the other can be good while the other one's bad. Okay, so let's get into this a little bit. We looked at cap rate. This is what we're going to use to analyze whether the property works. Just notice the equation. It doesn't change based on how big your down payment is. You can be 10% down, 50% down, 100% down. Your cap rate remains the same. It does not take into account financing. It only looks at how well the property produces. Return on investment. This is return divided by investment. Okay? So spend a minute here. Some of you, this is going to be very basic, and some of you, this is going to be a good review. Okay, so if savings account pays like 1%, right? So if you put $100 in there, investment, your return is going to be $1. Okay, that's return on investment. If you are lending, you're a private lender, somebody's going to do a fix and flip or whatever, you give them $100,000, assuming that they have it for a year. That would be a long project, but let's just assume a year to make the math easy. And you're making 12%, the return would be $12,000. It's a $12,000 return on a $100,000 investment. Okay, so where you get your returns, remember, in a rental is this. So return on investment is going to look like this. Return on investment. Okay, this is where people get hung up. The return, everybody can kind of figure out. Everybody likes to look at all the money they're making, right? But this is where people get hung up. So if you have a stock or you have an exchange-traded fund, it does really well. You put $25,000 into it. Okay, a year later, it's at $35,000. And I ask you, what is your investment worth? What would you tell me? 25 or 35? You'd say 35. You go to Schwab or Fidelity, you look at the screen, and you before it used to say this, and now it says this, and you're like, yeah, it's 35. And I could say, well, wasn't your investment 25? Yeah, but it's worth that now. Okay, everybody gets that. But when somebody buys real estate, and I ask them, okay, what's your investment worth now? They're like, well, I put 25 into it. Yeah, but what's it worth now? Like, what are you investing into it now? Well, I invested 25. Okay, so you invested 25, but over a year, you had 6% appreciation, you had some debt pay down, and it's worth 35. So that's what you have to plug into your equation, not 25. Okay, so this part right here was 25, goes to 35. This is a 40% increase. Okay? That's how it kind of works when you first get into a property, is you have this huge increase on your investment. Okay? Percentage-wise. So this increase right here just so happens to be the return for year one. That's what you made. You made that on the appreciation and the debt pay down, and that goes right there. But look what happens. This one was 40%, right? But you think about this. If you have a $100,000 property and it goes up 6%, it's worth $106 the next year. So when you have 6% on 106, it's not that much more than it was the year before, really. Same thing with the income. It's now 6.8% of 106 instead of 100. It's not that big of an increase. The loan, second year, you always pay off more on the principal, but not that much more, right? It's not 40% kind of more. So year two goes to 11,000, give or take. That's a 10% increase. This went up 10%. This one went up 40%. So what happens to your ROI? It goes down a bunch. Now, this is saying that for every $100,000 you have invested, you made 40 grand here and 31 grand here, 31% return. Pretty good return, right? That's how it kind of goes the first couple of years. If you map this out, like, it's crazy returns the first couple of years. But it does that. So in doing this spreadsheet and all that for 20 years, you map it out, and this is what it is. If you have one paid off, it will eventually get down to here. And this is why you have to continue to do your analysis of your properties, this is what's happening to your ROI over time. Those of you that have had houses through the downturn, or you bought them in the downturn, like you were like really smart, bought them like in 2012, 2013, whatever, this line is steeper. Like your ROI just plummets fast. But remember we talked about you have one, you take some money out, you buy another, and it had these crazy returns and all of that. This is what it looks, that example looks like if you look at it from an ROI perspective. It looks like this. Your ROI drops, you take some money out, it goes up. You can do this again and again and again. Lon Welsh, founder of Yorkcastle Real Estate, he is meticulous about doing his numbers like this. And when his properties go below a certain threshold, his threshold is 15%, he looks at that and figures out what to do about that and takes money out or sells it and buys another one and all of. And he has basically done this over and over and over to the point that he has 80 properties now. But if you keep your money working like that, you can keep everything growing at a much faster rate. So you have two options at this point. Okay, there's two things that you can do if your ROI goes below your threshold. Okay? Two. For those of you that don't know what a 1031 exchange is, it's just you're selling a property, taking that money and buying properties. Except when you run it through the 1031, you don't have to pay taxes on the gains. So
Yeah.
Yes. You defer the taxes. So you're just selling and then buying more. Or you can keep it, take cash out, and get another one. Those are really your two options to get your ROI back up over a certain threshold. So real world example. And this is from Lon Welsh. This is an actual property that he owned. Okay? He bought it for $183,000 in 2013. What do you think happened to the value of that property?
Triple.
It went up that much. Okay, so if you bought this property for this and it goes to this, how do you feel about this property? I love that property. Okay, so you do. It just makes you warm and fuzzy just thinking about it, doesn't it? Now, there are two parts to investing that you have to master if you're going to do well at it. You have to know the numbers and know how to make your numbers work and how to make all this come together, right? From a numbers, logical, Mr. Spock standpoint. But then there's an emotional standpoint because you love this property. Okay? You do. It's been so good to you. How could you betray this property by selling it? Like, really, it just doesn't feel right, right? It doesn't. And so there's a book, Thinking Fast and Slow, came out a few years ago. The guy that wrote the book is a Nobel Prize winner in economics, and specifically behavioral economics. So he has an example in the book where they have some people come in and they do like a questionnaire, something like that. I can't remember exactly what it was, but as a thank you, they gave them a pen, nicer than this pen. They gave them a pen. And they just sit there and talk to them about a minute or two, and they'd say, oh, just realized, in addition to the pens, we have these chocolate bars. And they're really nice chocolate, I guess, and they were of comparable value. Okay? And they said, you can trade the pen for the chocolate bar, and 80% of the time, people would say, I'm going to keep the pen. Okay? Well, then, there were people, imagine this is a chocolate bar. They would give them the chocolate bar first. Talk to them for a couple of minutes, and say, oh, by the way, we also have these pens over here. Would you like to trade it for a pen? You can just trade that for a pen. And 80% of the time, people said, I will keep the chocolate bar. In a couple of minutes, people have an attachment to the thing that they've been given. It's mine. I own this. I'm not giving this up. I have an attachment to it that fast. So imagine how it is for a property that you've owned for 5 years. It has been so good to you. Like, you can't let it go. Okay? So I'm going to suggest that you let it go. That take the emotion out of it and just learn your numbers. We're going to start a support group for people that are letting go of rental properties. So it is an investment. It's not a relationship. If you dump your property, it will get over it. It will move on. It doesn't feel the same way about you as you feel towards it. Okay, so back to the numbers. This number right here, the investment part of this, when that went way up, this went way up, right? So what happened to the ROI? It went down. What's his threshold he wants to make? 15%. That's below his threshold. So now, question, what do you do? Do you do a 1031 exchange or do you take cash out? Who thinks 1031 exchange? Who thinks it's a trick question? Okay, it's a trick question, okay? Because remember, this just tells you how well your money's working, not if this is a good property. Okay? That's just telling you how your money's working. To know how your... So let me give you an example here. To kind of make clear what ROI is kind of measuring here. You have $10,000 in return. And you have a particular investment. I'm going to show 3 slides where this number is going to change and this number stays the same. and the property value is going to stay the same. The only thing that's going to change is the investment, okay? $100,000 property, you have 10% down, $10,000 return, 100% ROI. Now watch, the property is going to stay the same, and this is going to stay the same. This just dropped to 20. This doesn't tell you if this is a good property. It just tells you how well your money is working, how much your money is returning. That's it. So you have to have something that is going to show you how well your property is performing to be able to tell if this is a good property. That's going to be cap rate. So you can see right in the equation, it has this instead of the slotted pig, right? That is going to, tell you how your money is working. So this was his cap rate when he first bought it. He bought it for $165, put 18 into it. This is his net operating income. Is that good? Yeah, that's pretty decent. This is what it was in 2016. 4.7. Is that good? That is really, really bad. So the reason for that is your income went up 14%, but the property went up 78%. Now, if you're going to have a problem with cap rate, you want it to be for this reason right here.
I'm okay with that.
You're okay with that, but in this case, you have a situation where the money's not being put to work well, the property is not producing, so this ends up falling from here to here. So that whole being attached to that property, you can see, you can get really attached to this property and go, this has treated me so well. But if you look at what is it doing now, if this is a relationship, you have a boyfriend or a girlfriend that's a 4.7 cap. Do you could
1031.
So so I dated a girl that was a 4.7 cap, right? My wife here is like a 20 cap. Like, what's better? Like,
What about a 2 cap?
He broke up with his property and got other properties, right? So if you look at this purely from a analytical standpoint, one of the things that like Warren Buffett talks about is be greedy when others are fearful and fearful when others are greedy. A lot of times people just get into that property and it's worth so much and their debt coverage ratio is really high and they feel secure and all that. They're just not doing the numbers. So can you have a bad ROI and a good cap rate at the same time? Yeah. Go back to this example. I mean, property, you go from really good to not as good to not really good, but what if it was a 7 cap? The problem is the money being tied up in that property. You have too much money tied up in it. So this, you have one, you take money out, and go get another one. And that's how you determine it. You have to start first by how is my money producing? And you have to look at those things separately to figure out what you're going to do with this. Okay. So I'm going to show a couple of spreadsheets. I have a blue spreadsheet and a green spreadsheet. Like literally, like this is for analyzing a new property. This is analyzing an existing property. They're a little bit different because there's some different things you have to look at. New property and existing property spreadsheets. And I have these for download on my website. If you want to go to that, this is my website, realestateforcolorado.com. I also have cards, so you can pick that up, and I have the website on there as well, or you can just write that down. Okay, so looking at the new property spreadsheet first. The thing that's cool about this is a lot of people get caught up in, hey, I don't want to do the analysis because it's too complicated. If you have a good tool, a good spreadsheet set up, you don't have to have a lot of pieces of information. Once I populate one of these spreadsheets once, because things like your vacancy factor, I'm going to have that. It's going to be the same on every time I do a spreadsheet. So once I have filled out most of this, there's only 5 pieces of information I need to analyze a new property. Price, rent, taxes, insurance, and HOA. I can just look at one after another, and they take about 2 minutes each, and I can fly through a lot of properties. Okay, so just to zoom in on the spreadsheet here, because I know that you can't read that, but like here is one that I just purchased. Purchase price. The 5 pieces of information that you need over and over, I have in dark blue, and the rest in light blue. Acquisition costs, that's going to be like your appraisal, your closing costs, and just all those expenses that you have when you acquire a company. This is my monthly rent. My vacancy factor stays the same. Taxes, insurance, HOA, repairs and maintenance, I'm always going to have the same. Property manager is always going to be the same. My mortgage information, once I populate that once, I'm probably going to be leaving that the same. Okay, so, like my website that I had, I showed you earlier, price, rent, taxes, insurance, HOA. The only thing that's not here is insurance. You can pull all that information in pretty easily. There's other ways to get it. You can talk to your realtor if anybody's a realtor. The thing out the MLS, you can say, hey, here's a criteria. You get an email that, say for condos that are under 200,000. And you can pull a lot of that information off of those emails, those things off the MLS. You're going to have the price, the taxes, the HOA, and then you can go try to calculate the rent. This just makes it a little faster, but all of it's available. So this is my latest rental that I just bought. So feeling really good about that one. That was one that, I've looked at a lot of rentals, and when I found this one, like I walked in and said, yeah, I'm buying this one. Like there's no doubt this is getting under contract like right now. Okay, so once again, that's the website to go get that. So the new property spreadsheet, just look at the whole spreadsheet. Oh, this changed my my zoom here, scrunched my screen in. But this is what the whole thing looks like. You're going to have your cost of purchase, and then you have operating income minus operating expenses is your net operating income. It just kind of flows top to bottom, and then you subtract your annual loan payments. This is just principal and interest, is your annual cash flow. And then you have this little box here up at the top that gives you all the other information. So cap rate, cash on cash, debt coverage ratio, monthly cash flow, cash out of pocket. So I bought this with a 401k, so the cash out of pocket is really high because you have to put bigger down payments on stuff that you buy with retirement accounts. Okay, so the existing property, sorry, I'm going to have to zoom this back out since it changed the dimensions when it went up on the screen here. Little bit different. You have to assume an appreciation. I just put 6% because that's the long-term appreciation rate for Denver. Then you have to, a lot of it's the same. Operating income, operating expenses. But then it's the actual loan that you have, not a percentage of what I think the sales price is going to be or whatever. You actually put your actual loan information. Because it needs to know how much you've paid this thing down in order to calculate ROI. So this is another property that I own that I bought a couple of years ago. That is my current ROI. Zoom in on this box. Okay, so when I was talking about, hey, let's get your ROI back up and you take out money and all of that, who's thinking that sounds really risky to have a bunch of extra leverage? So to give you an idea, I said that my threshold is 15%, and I actually got that number from Juan Welch because I figured he's done all the math. He's really smart at all this. But here's one where I have a 21% ROI. I'm well above the 15. It's going to be a few years probably before this thing gets below 15. Okay? My debt coverage ratio is 300%. What that means is, let's say that you have principal and interest of $1,000 a month. For those of you that don't know what debt coverage ratio is, that means that my net operating income is 3 times that. It is 3 times that. So pretty safe. This is not, so when I talk about, hey, when you get below a certain threshold, take some money out, do a 1031 exchange or whatever, I'm not saying go crazy on the risk here. This is pretty safe. I'm cash flowing $765 a month factoring in a maintenance allowance and a vacancy allowance, I'm cash flowing like that. That's not, and I'm still not even close to the point that I would take money out yet. Okay. So I want to show you also, okay, so my website, wow, that's crunched that down. So my website, realestateforcolorado.com. Man, the menu doesn't show up at all up on the screen there. But there's a menu across the top. But long story short, you can get the spreadsheets. And anybody heard of HomeBot? You guys familiar with HomeBot? So a couple of you that are realtors are probably. So HomeBot, you go to the HomeBot link here, okay? And you click on that, and it'll bring up this page. And you fill this out. It's just put your name and you put your property in there, okay? Then they'll send you an email. Looks like this. And you click on it. And it brings you to this HomeBot page. And what it is this. It's going to pull in all your information about your loan, your property, all of that, and give you an idea of the value of this. Okay, so what HomeBot does is they market to realtors, and then we provide this free to customers. Okay, and with all this information you get about your loan and your property and all of that, there's some pretty cool things that you can do with this. First of all, it's going to tell you the value. The one that was on the green spreadsheet where I was showing you the ROI. I got that number here. This is how much it's worth. It's better than a Zestimate because in addition to the public records that Zillow is going to use, they also have a contract with RE Colorado. So it's actually looking at live listings. So it's way more current. It's far better. But also, all the information I got from my mortgage because, you may forget what your rate was or, your term or how much the loan was for. That's all right there. This is how much you have towards principal. You need that in the spreadsheet. But check this out. Now, I said I was cash flowing $765 a month on that property. Let's say I take $700 a month and I just start putting it towards the mortgage every month. It'll show me that I will save $43,000 in interest, and I'll pay off 22 years earlier. 22 years. So there's just all these kinds of cool little widgets and things that you can do to look at what you can do to save money, how much you could spend if you're buying an investment property or trading up to a new home, And then it has things like if it was an Airbnb and you rented it out like 12 nights a month, and this is an Aurora, so this is probably like... So, and then if you put that towards your payment, how fast you would pay that off, and then the estimated cash you could take out. If you figure out that your ROI is too low, how much cash can you take out? Right here. So this one I own with retirement money, so I can't go 80% loan to value. This is where it's normally for a regular rental. It's going to be that I could take I could be 75% loan to value. I have to be at 65% loan to value on my 401k. But that's how much you can just play with all these numbers. It's kind of cool. So anyway, you can sign up for that on the website. And then the other thing that I've done is this learn part is like I have a video on how to use spreadsheets. I have one up there for the blue spreadsheet. I'm creating one for the green spreadsheet. And then I'm going to be doing some other things explaining, because who thought it went really fast trying to figure out what ROI was and cap rate and all that? So I'm going to put some videos up there just kind of explaining that so you can go back and review that. And that's going to be in the learn section. So anybody is like, yep, I need a review on this. You want to grab coffee? We can sit down. We can go over the spreadsheets, the concepts, everything. And I'm available for that because it's what I do. So,
all right, guys, let's give him a big round of applause.